Good day, everyone, and thanks for joining in on the webinar. So we'll start with the global trends and then we'll move to the domestic key market events. So economic activity continued to be in expansionary territory. So as we can see, whether from the economic activity surprise indices or global PMI indices, activity in fact picked up in January from December. So if you look at the manufacturing PMI, it saw some moderate decline in the months of November and December, and now again it started to pick up. The same situation unfolding in services as well. Largely, we can see, in fact, India was a major contributor towards global growth, and we saw strong hiring as far as the service sector is concerned in India, Japan, UK, and the US. Even on the new order side, services PMI continue to show robust activity. In the manufacturing sectors as well, we saw new orders increase much more rapidly than stocks of finished goods. That means that as new orders picks up, it will lead to more raw material demand as well, which should further boost consumption and demand going forward as well. So overall, we do expect that the current manufacturing economic activity is sustainable in the short term. Most of the countries now at least have a broad understanding of the current tariff landscape, and now most of the corporations have also adjusted to the new tariffs. So that while tariffs continue to change, but largely corporations as well as exporters have started to live with the current uncertainty, and now we are seeing some green shoots emerging in manufacturing as well. The same trends we can see in the economic activity surprise index as well, which measures outperformance compared to consensus expectations of key economic data points. So as we can see in both US and the Eurozone, economic activity continues to surprise on the upside. And one of the major reasons is one, the tariff overhang is gone for now. And even on the fiscal side, with EU spending a significant amount on the government expenditure side, whether for defense procurement or sustainable energy, it's overall leading to better job hiring and better profitability from corporates as well. Moving on, that's also now reflecting in the commodity prices. So if you look at commodity index in the month of January, that saw its biggest increase in last 25 years. And the reason was a very strong economic activity coupled with geopolitical risk. So while the tariff uncertainty is going down, if you recall, in the month of January, there were major frictions between the US and the Eurozone regarding Greenland. And at that point of time, many European countries, including Denmark and Norway, had talked about reducing US treasuries and US dollar holdings as well. So whenever there is an uncertainty on US dollar, typically US dollar and commodities have an inverse relationship. So at this time when the US dollar weakened because of anticipation that probably some of the European countries will reduce their dollar holdings, that is a time we also saw sharp rally in silver, gold, and other precious metals. So that was a time at the height of frictions between the US and Eurozone regarding Greenland. We saw precious metals rising. And if you look at other metals, industrial metals like copper, aluminium, etc., they continue to be in slight short supply and very high demand due to AI and other technology-related uses. And overall, commodity cycles seem to be doing quite well. And if you look at the energy sector, even on the energy sector, there were concerns that probably US and Iran will enter into major escalation, with US sending its warships near the Bay of Iran, and we saw oil prices also rising because of that. On top of it, if you look at the weather patterns emerging in Europe, it was a very harsh winter, very low temperatures, and that's why we saw pickup in natural gas prices as well. In fact, if you look at the stock today as well, natural gas stocks in Europe continue to be on the lower side and prices continue to move upwards. And that's why we saw a broad commodity rally across precious metals, industrial metals, as well as energy. But while metals and energy prices continue to be on the up, we had food prices which are continuing in decline. So if you look at the right hand side, which is the UN Food Price Index, that shows a consistent decline where the food price index declined for the fifth consecutive month. And we saw price declines in dairy products, sugar, meat, which offset increases in cereals and vegetables, oil. Of course, for India, since we import a lot of vegetable oil, it's quite critical for us to monitor it constantly. But so far, things are well under control. Our inflation continues to remain moderate. Coming to the bond side, if you look at the major, bond yields movement across advanced as well as emerging economies, as we can see, we saw uptick in US, UK, Japan, Australia, etc. The reason for the uptick in major economy bond yields was the movement in Japanese 30 and 40-year bonds, which saw a up move of 25 to 30 basis points in the month of January. The reason was the new Prime Minister assuming office, Sanai Takichi, and she has pledged to cut taxes on food items, which led to fiscal worries, and that led to situation of bond yields going up. And as a lot of carry trades are still conducted in the yen, any major concerns on the Japanese bond yields and currency leads to pressure on the anchor countries as well. That's why we saw US bond yields and UK bond yields going up apart from Japan. In Australia, of course, the RBA continues to remain concerned on inflation. Growth is doing quite well, and hence there are expectations that RBA may go for further rate hikes as well, and that's why we saw increase in Australian bond yield. But if you look at emerging markets, it was a mixed bag. Some of the emerging markets like Brazil, Mexico, China, they saw decline in bond yields in the last month as they continue to benefit from a situation of reasonable growth but very low inflation. And while if you see in emerging markets like India, we saw some uptick in yields as concerns on fiscal consolidation continue to remain. Market participants remain concerned on how the government would really fund its fiscal deficit ahead of the budget. Now coming to the India trends, and the most important, I would say, event for last month was the MPC policy, which was conducted on this Friday, 6th of Feb. And as we know, the MPC voted unanimously to keep the policy rate unchanged at 5.25 and retain the neutral policy stance. Professor Ram Singh, one of the committee members, voted to move the stance from neutral to accommodative, as he had done in the previous policy as well. So from a stance perspective, it was a 5-1 vote, whereas for keeping interest rates at the current policy rates of 5.25, it was a unanimous vote. If you look at the major economic projections made in the current policy, we see some upward revision in the inflation projection. So if you look at the Q4 inflation projection for FY26, it was revised upwards by 30 basis points from 2.9 to 3.2%. If you look at for FY27, largely a 10 basis increase in the H1 FY27 CPI projections, with 1 quarter inflation projection revised upwards to 3.9 to 4, and the Q2 projection increased from 4% to 4.2%. One of the reasons RBI gave on inflation, estimates was because of the low base effects. Because inflation was so low at the same time last year, it's leading to slight base effect, and that's why inflation, although month-on-month movement is not very high, but just on the base effect, inflation is expected to pick up moderately. While inflation is expected to pick up, but if you look at the actual numbers, the Q1 and Q2 still close to RBI's target of 4%. So broadly, we do expect that RBI should remain comfortable with these inflation projections and continue to keep these policy rates lowered for longer. Um, Secondly, although RBI was supposed to give inflation projections probably for the Q3 of FY27 as well. As we know, there's a new CPS series coming on 12th of February, which is based on latest 2024 household consumer expenditure survey, and it will most likely reduce weightage towards food inflation and increase weightage towards more of core inflation. Even within food inflation, it is expected to reduce weightage towards cereals and it is expected that weightage for protein items and milk and other products will increase. So overall, the trajectory of inflation, the nature of inflation will undergo a slight revision, and that's why RBI mentioned that they will probably provide their full year forecast in the April after studying the new inflation series. If you look at the growth estimates as well, as we know, the RBI policy happened after the announcement of US-India trade resolution. We will discuss it in greater detail in the subsequent slides, but as we know, in the last 6 months, India was facing a very high tariff of 25% plus 25% penalty to because of buying Russian oil. So the total tariff in effect for India at the headline level was 50%, and the effective tariff rate, because of some of the items were exempt, like pharmaceuticals and telephones, the effective tariff rate for India was 32.9%, which was one of the highest in Asia. So when the announcement came of the resolution of US-India trade deal at 18%, and India has also promised to stop buying Russian oil, so that penalty will also go away. Broadly, it was expected that that will lead to some amount of growth uptake. And as India has also signed the FTA with Eurozone in January, so now you have a very integrated market, which is a FTA already with the UK, with the Australia, with Europe now, and now it has a trade agreement with the US. So that's why it gave slightly higher confidence to RBI that economic activity is doing well, and with signing of all these trade agreements, the economic activity should further pick up. Although the announcement of the US-India trade deal was still a bit sketchy, and hence RBI has not assumed the growth estimate revision taking into account the US policy, but broadly they have taken into account the FTA signed with Eurozone. So as we know, they have revised the growth estimates target by 0.2% for each quarter of Q1 FY27 and Q2 FY27. So it goes from 6.7 to 6.9, 6.8 to 7. The bond market before this policy was announced was expecting RBI to cut CRR or infuse more liquidity measures, and that was disappointed. One of the reasons why market was anticipating RBI to give some liquidity measures at the current policy was that because of very tightness in money market rates. So for those of you who may be tracking money market rates or who are just listening in, 1 year CD rates have gone up from 6.8 to 6.85% to all the way to 7.2% in the month of January. So money market rates have gone up significantly, and this is typically happening in Jan to March quarter end, where yields spike up on credit growth. But investors were expecting RBI to announce some liquidity measures because at the absolute level, these yields have become quite high. Just to give a perspective, last year when the policy rate was 6.5%, the 1 year CD rate was around 7.5%. And when now the policy rates have gone from 6.5 to 5.25, the CD rates are just at 7.2. So not a material difference there. Hence, the banking community and the market participants were expecting RBI to announce something on liquidity, but RBI largely maintained status quo, and they assured the market that they will provide liquidity for all productive purposes whenever it's required by the market, whether in terms of OMO, whether in terms of FX buy-sell swap or BRR options. So RBI is ready to provide liquidity, but RBI thought that probably given that liquidity is already improved meaningfully So from just about 60,000 crores now, it's come to 3 lakh crores headline liquidity. RBI probably didn't need to do OMO to further boost bond market. And that's why we saw some increase in bond yields on the day of Friday as well, when bond yields went up by 5 to 6 basis points. So the 10-year bond yield moved from 668 all the way to 675 as well, because market participants expected RBI to take some liquidity measures, which RBI rightfully, in our opinion, assumes that they have already done enough. And if you look at the overnight rate right now, it's already at 4.5 compared to the policy rate of 5 quarter. So the overnight rate in the interbank market is already 75 basis below the policy rate. And that's why probably RBI did not take any action on the liquidity front, but it assured the market that whenever there is any dearth of liquidity, RBI will come and provide liquidity through all its operating channels. So, on a nutshell, policy largely remained status quo. The stance remained at neutral. The policy rates also remained at 5 quarter. Inflation, although was revised upwards, but RBI took comfort that largely it was due to base effect and not incremental price momentum pressures. On the growth front, RBI has taken comfort from the FTA signed with Europe and other countries, and hence RBI expects pick up in exports also. That's why the growth numbers were also revised. But more importantly, while market looks at RBI for policy and its forecast, what we also need to evaluate RBI policy in terms of regulatory, in encouragement to banks to support credit growth as well. So if you look at this RBI policy, it brought some new reforms in the REIT-based lending. RBI allowed banks to lend to REITs. So far, under the current regulations, banks are not allowed to invest directly in REIT bonds. So they can lend at the SPV level, but they cannot buy bonds of REIT entities. Now, with this policy, RBI also allowed banks to buy REIT entities, which should improve liquidity in the REIT market, which should also lead to spread compression for REIT bonds. So overall, a positive move by RBI. On the SME lending also, RBI has increased the collateral-free SME lending limit from 10 lakhs to 20 lakhs, given that now in the last 3-4 years, the size of the economy has also grown, size of the MSME is also grown, and that's why they've increased the limit at that level. And that's why, so if you look at the policy just from a interest rate lens, probably it was neutral. But if you look at the policy from a regulatory lens, I would say the policy was quite accommodative. They promoted ease of doing business for smaller NBFCs. They gave benefits, to the REITs that their bonds can be bought by the various banks, and they also gave relaxation to the banking system in other channels. So broadly, an accommodative policy from a regulatory standpoint, and even on the interest rate standpoint, it continues to remain well anchored towards 5 quarter. We think at least for next 6 to 9 months, interest rates could remain at these current levels. Coming to the budget, so while we have covered budget in a separate budget call, but I thought it would still, for anyone who missed the call, happy to discuss the budget here. So broadly, before this budget, government used to follow fiscal deficit to GDP target. So every year, government would set a fiscal deficit target, and the government would conduct its expenditure in such a way to ensure that it meets its fiscal deficit target. But from this year, the government changed its goal from fiscal deficit targeting to debt to GDP targeting. The reason behind was quite simple. Debt to GDP is a globally accepted benchmark used by many governments and multilateral agencies. They wanted to move to the global best practices. The second benefit, which the government also thought, was that moving to debt to GDP gives them a better flexibility to manage their fiscal situation depending on the growth cycle. So if in case the growth cycle is weak, government can print slightly extra, run a slightly higher fiscal deficit without, attracting any negative attention, and vice versa. So overall, this year the government has moved to debt to GDP targeting. So from 56.1, the government announced that it's moving to 55.5%, which broadly resulted in a fiscal deficit number of 4.3%. If you look at the sources of revenue, and if you look at the YOY numbers, Largely, they are quite conservative. So they look at corporate tax, income tax, which is expected to grow at 11% by the RBI. And if you look at the nominal GDP growth, probably this year it's close to 10.5%. So the growth rates are quite conservative. If you look at excise as well, it's not a material growth. Probably the government is in a position to hike excise for oil companies without impacting the customers, of course. And hence, we do expect that probably that will once again become a modus operandi for the government that to uh, hike excise duties there. If you look at the GST part, that's where the government has taken a hit. So if you look at the YOY numbers, the GST collection is going down by 2.6%, and largely it's because of the GST rationalization measures that the government took after the US-India trade issues. If you look at on the expenditure side, the government has kept the same level of expenditure despite all the issues in the fiscal. If you look at FY27, the government is forecasting a 11.5% growth in capex to a record 12.2 lakh crores or 3.1% of GDP. So government, despite facing pressures on the spending front, is trying to maintain capex. It's trying to boost long-term capacity, for India, and we do expect that if you look at the execution so far, they are on the right track. So we may get close to similar number in the full year budget next year. So while fiscal consolidation continues, so as you can see from the chart on the left-hand side, the fiscal consolidation has come all the way from 9.2% in FY21 to 4.4% in FY24. So like I said in the beginning, there is an update on the US-India trade deal. So just to recap, US had levied a 50% tariff on India, 25% on reciprocal basis, and 25% as a penalty for buying Russian oil. So the US President and the Indian Prime Minister announced a trade deal which will lower the tariff on Indian goods to the US from 50% to 18%. India will cut tariff on US exports to zero and also buy US goods worth $500 billion in 5 years. And the other commitment that India made to the US is that they will stop buying Russian oil purchases. And probably that's why one of the key triggers for the removal of the tariffs as well. So if you look at the INR, in the last 6 months, INR has been the worst performer in Asia because of the pressure from the India-US trade deal. All of them face higher tariffs than India. So while India was not probably the first country to negotiate the trade deal with the US, but they have negotiated well. They have tried to ensure that the interest for the domestic industry, especially the sensitive industries, are well protected, which I will discuss in the next slide. So if you look at the impact of the tariff, so if you look at the bottom rows on the first chart, many items which were impacted by the tariffs, and which were levied post August. So September to November is a good time to see. We see a very sharp dip. So for example, agriculture declined by 29%. If you look at other, iron and steel, 10%, aluminium, 29%. These are the kind of decline that we have seen. If you look at, leather and footwear, which is also a big source of export, it saw a decline of 15 to 60%. So these are the labor-intensive industry which had seen a sharp decline, while at a aggregate level, because of the strong growth in fuel, electrical machinery, etc., we did not see any major impact on the exports. But the problem was at the granular level. These industries would have faced difficulties. If you look at, so there's a lot of noise that India has also opened up its agriculture sector to the US. We believe it's not true. If you look at the items which have been mentioned in the statement, which is your DDG, sorghum, fraudulence, etc., US is already exporting these to India. So whatever items, especially on the agriculture side, US is already exporting to India. Only on those items, India has reduced the duty to zero, or in some cases made it very minimal. So if you look at the sensitive areas like cereals, which is very important for our farmers, or frozen vegetables, pulses, etc., all of them are so far outside the scope. So only the items which are exported to India by the US, only there duties have come down. If you look at what's happening to Indian agriculture exports, in fact, on India, in most of the items, especially pertaining to agriculture, US has moved the duty to 0%. So, in fact, now India gets the benefit, especially on the agriculture side, to export to US at cheaper tariff rates. But one of the things which I think market participants are not talking about in the US India tariff deal is that India will have to eliminate non-tariff barriers. So whether it's import quotas, it's licenses, there are also some, benefits which are given to the importers if they import certain items. That all will be eased and removed in the subsequent months. And also, India and US will work on the removal of barriers to digital commerce, and not India will not be able to tax digital companies operating in India. So for example, if you would remember, some 4 or 5 years back, India had levied a 6% Google tax or an equalization levy to increase taxes from these services. But now with US India working on a clear digital trade rule, probably India will not be able to tax these corporations who are operating in India. So that's a very big change which is there in the policy. So that's something which to be looked at. So of course, the first level goes towards understanding the immediate impact of trade. But I think these two items are also very, very critical for Indian domestic sector as well as Indian current account deficit. Broadly, credit momentum remains strong. So as we can see, non-food credit increased 13% growth, like we were discussing in the RBI policy. RBI, apart from interest rate cuts, is also easing regulations to ensure strong credit growth. So for example, last 1 year, RBI has allowed banks and NBFCs to do overlapping business, which was not allowed. RBI has also allowed banks to lend to real estate sector, which was not allowed earlier. In this policy, RBI allowed banks to lend directly to REITs. So that's something which RBI has been trying to announce every policy, some regulatory dispensation to ensure that banks can easily grow credit, and that's largely what banks are focusing right now. But that's also, of course, leading to uptick in money market rates as well. If you look at the sectoral growth, whether you look at micro industry, whether you look at large industries, they all are going quite well. So on the yield curve, as you can see, the green bar on the right hand on the downside chart, long end yields continue to rise. So for the last 1 year, we have been talking of steepening. In fact, this slide, we only changed the chart. The heading has remained the same because the curve continues to steepen as the rate cycle is close to getting over, and every month we see as supply on the demand on the bond side picks up, especially on the long end. That as the demand gets muted, we are seeing further rise in bond yields on the long end side. So this is quite an interesting table. So if you look at the AAA 1 year rates, and if you compare the January 26 to December 25, you will see the 1 year AAA rates went from 683 to 7.17. So this is what we were talking about. We said that because of high credit growth, now banks are issuing CDs at aggressive levels, and that's why people were expecting RBI to step up. This is why banks were expecting that because of rise in these 1 year AAA rates, it will be difficult overall for the economy. If you look at the situation, whether in 3 year or the 5 year or even the 10 year, broadly the situation is same. And the 10 year AAA also yields have gone from 730 to 740, 5 years from 710 to 752. So broadly the situation is same when you look at AAA, AA. But we think that as credit growth slows down, which it slows down seasonally in April, and as liquidity improves, the credit curve should also normalize, and the 1 year, 3 year curves should rally from current levels. So broadly on the outlook part, so while inflation for India continues to be low, it continues to be around 4%, which gives comfort to RBI to maintain a lower for longer bias, and growth remains quite strong, which also means that probably RBI does not need to do much. So while in a situation you are a situation of easy inflation and strong growth, so probably it's better to expect RBI to maintain on an extended pause or a lower for longer rates regime, where RBI may stick around 5 quarter and really wait for inflation to come up before taking any monetary action. If you look at the growth outlook, we have signed, like I said, trade deal with the UK, Eurozone, and now the US. So it gives a lot of clarity to exporters, and it does not just gives clarity to Indian exporters. It gives clarity to the rest of the world exporters as well, that they know that now India is very well integrated as far as the trade rules are concerned with the global value system. And it's if somebody wants to diversify away from China, now India offers a very compelling opportunity. So as we saw in the chart as well, one of the previous slides, India is now also the lowest tariff economy in the whole of Asia. So from a tariff side as well, from an overall trade integration, India is in a very sweet spot. So in this situation where growth is quite stable, inflation is also relatively stable, and RBI is expected to maintain an extended pause, we think the short to medium end of the yield curve is the most attractive from risk reward perspective, because the one, you're getting a decent accrual over government bonds, and also you're getting, there is a heavy supply, there is no further you know there is a heavy supply, there is no further monetary policy benefit that long bonds are expected to get, and hence we expect incremental gains to really remain limited. We will look to add on the portfolio basis, but it will be based on tactical opportunities if we get very uh, you know dislocations in the bond market. So broadly, what does it mean for investors? So investors who are looking at 3 to 12 month investment horizon can consider money market or low duration strategies, because you're getting very good carry over the overnight rate. Overnight rate is 5 quarter. The yields in these portfolios are upwards of 7%. So very good spread as long as one can hold for 3 months. Investors who want to invest for more than 12 months but less than 2 years, as 1 to 2 year segment, can consider moderate duration products like short-term corporate bond funds, because these funds also give decent accrual as well as some emerging opportunities. And investors who are looking to invest beyond 2 years, can consider income plus arbitrage funds for tax efficient returns. So broadly, I'll stop here and we'll open the floor to questions. Thank you very much for listening.
Thank you, Anurag, for sharing the valuable insights. We'll jump to the Q&A session. So the first question is, for the first time in many years, India has benign inflation, credible fiscal consolidation, and supportive liquidity. Yet, long bond yields remain high. So what risk or uncertainty do you think the bond market is still pricing in?
So I think the bond market is pricing in heavy supply uh, in the upcoming years, because, like I said, the rate cut cycle is over. So broadly, there is a certainty that from here rates may not go lower, but after probably 8 to 12 months, rates can in fact go and start reversing. And on the other hand, what's happening is the best of fiscal consolidation is behind us. So as we were discussing in one of the slides, now fiscal deficit from the peak of 9.2% in FY21 has now come to 4.4 in FY26. But from here on till 2031, because now the government is focusing on debt to GDP, the fiscal consolidation is not. So at a gross level, the government may keep on borrowing between 16.5 to 17.5 lakh crores at the bare minimum. And that's why the market is concerned about the demand supply dynamics. So in absence of RBI OMO, it will be very difficult to buy bonds at this kind of supply. That's largely the supply pressures we are seeing getting expressed in the bond market.
Thank you. So the next question is from Mr. Amit Gupta. Please share your views on USD INR trade deal, especially from the NRI investors' point of view.
So we think that probably rupee will remain range bound in the range between 90 to 91, although it should appreciate because all the concerns and overhang on India, especially from the trade related side, are gone. But do keep in mind that RBI has spent a lot on FX intervention. So RBI is sitting on a short forward book of $63 billion as of December 2025, and ultimately at some point, RBI has to give delivery of these forwards. And even if you assume a 50% delivery rate for RBI, RBI has to deliver about $30 billion, in 1 year and beyond. And that's why we think that, as inflows pick up for India, probably RBI will rebuild its war chest, and hence we may not see a material appreciation of INR because there will be RBI intervention to rebuild, its FX reserve, which RBI spent last year. In fact, that's what RBI's policy always has been. So in times of depreciation, RBI intervenes and tries to ensure that the volatility on USD INR reduces. And when the time of appreciation for USD INR comes, RBI tries to buy more dollars so that it can intervene in periods of distress. So broadly, we think rupee will remain range bound between 90 to 91. It will require a very, very significant inflation or growth shock for rupee to move either ways, either below 90 or above 91.
Thank you. So the next question is, with FY27 gross borrowing expected around 16 to 17 trillion INR, how do you see the term premium evolving across the yield curve?
So I think the term premium will continue to expand. The most vulnerable segment is the 10 to 15-year segment, because that's where the government may move towards the bulk of supply, because what's happening is the long end yields have already adjusted meaningfully. Now the 40-year GSEC is trading around 7.5, and the 30-year GSEC is trading around 744, 745. So overall, 30 years already widened quite a lot. And on the 10-year side, probably the correction has not happened materially. So that's where we think the 10, 15-year space could remain vulnerable. While on the shorter end, because of the liquidity, that remains quite ample, and hence we expect short end rates to remain anchored.
So the next question is, the RBI seems to be influencing the financial conditions more through liquidity than policy rates. Should investors interpret this as both a shift in the policy objective and the beginning of liquidity-led bond cycle rather than the traditional rate cycle?
So there is a reason why RBI is intervening on the liquidity side. So if you look at the RBI liquidity framework, the framework suggests that RBI should maintain the weighted average call rate closer to the policy rate. Since the current policy rate is 5.25, what RBI has been doing, on the liquidity side, is largely sterilizing for its FX intervention. So, like we were discussing in the previous questions, because the trade deal was unfavorable for India till last week, there were consistent outflows from India, and INR was weakening. And to support the INR at that point of vulnerability, RBI intervened quite heavily in the FX market. So as RBI intervenes in the FX market, to sell dollars and buy rupee, it broadly, inadvertently reduces system liquidity. So whatever RBI was doing on the liquidity side, whether it was FX buy sell swap or PRR or it was OMO, it was largely to infuse liquidity because of its FX intervention. So as FX interventions reduce, even liquidity intervention should also reduce.
All right. Thank you. We'll take one last question, which is, the gap between the policy rates and the long-term yields is wider than usual now. So does this environment favor extending duration or focusing on accrual or a roll-down strategies?
We think that it's, from an investor allocation perspective, it's best to focus on accrual strategies and look at moderate duration products like short-term fund or a corporate bond fund, which typically run duration between 1 to 3 years. The reason being that, like I said before, liquidity is expected to remain quite strong. RBI is already committed that it will maintain liquidity at 1% of NDTL. So you are looking at a liquidity of 2 lakh crores plus, but at the same time, you are seeing fiscal concerns on the long end. So while the dislocation on the curve, especially because of this borrowing number, will provide opportunities to investors, I would say it's best managed by fund managers within the fund. So if there is any opportunity, of course, fund managers may take advantage of the opportunity, but it's very difficult for the investors to manage it on their own and build a portfolio of 2, 3 year bonds or 30 year. It's better to invest in a fund which can take all these calls and provide better risk.
Thank you, Anurag, for answering all the questions. And thank you, viewers, for joining us today. We trust that the insights shared by Anurag have helped provide a clearer understanding on the current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today, and we look forward to welcoming you in our next event. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.